No one handed you $1. Not one. Your parents rented a 2-bedroom in a city that didn't notice them. Your father worked maintenance. Your mother worked retail. There was no trust fund conversation, no family portfolio, no head start. You understood the architecture before you had words for it. You were 14 years old. You filed it somewhere permanent. You are 19. You take a second job, warehouse work, evenings and Saturdays, $13.50 an hour. You don't spend what you don't have. That is the entire first principle. Nobody teaches it plainly. You arrive at it through default. Your savings account opens with $400. You stare at the balance. You feel something unfamiliar, not pride, something quieter, more structural, a first recognition. Money not spent is still in play. That is the whole idea. You don't know that yet, but you feel the shape of it. By 22, you have $6,200 saved. You open a brokerage account. You deposit $2,000. You buy a total market index fund. You don't fully understand it. You understand enough. The machine needs capital to run. You are providing capital. Your coworker buys a truck on credit. You say nothing. You just don't follow him. That gap is quiet. It is already compounding. You can't feel it yet. That's fine. It doesn't require your attention to function. Your rent is $780 a month. You track every expense, not obsessively, methodically. You find $300 going nowhere each month. You redirect it into the account. You don't call it investing. You call it not wasting. That framing is more durable than motivation. It holds when the discipline fades. You need something that holds when discipline fades. You are 25. Your income is $48,000. Your savings rate is 23%. Most people your age save nothing. You don't announce this. You just do it differently. Not because you're smarter, not because you're luckier, because you made one structural decision at 19 and kept it. Consistency is operational leverage before you know the term. You are already running it. Your employer offers a 401k match, 4% on 4%. You run that number once. It is a 100% return on every matched dollar before the market does a single thing. You max the match that week. You never undo it. The account starts to feel different. It grows without your effort. You are beginning to understand what that means in practical terms, not textbook terms, your terms. The machine is feeding itself now, quietly, without asking your permission. You are 28. You get a promotion. Salary moves to $62,000. Your first instinct is the apartment. A better one? A car that isn't 11 years old. You pause. You ask one question. What does this become in 30 years? You keep the apartment. You keep the car. You redirect the raise directly into the brokerage. You feel something that isn't sacrifice. It's closer to clarity. You chose structure over signal. That choice is invisible to everyone who knows you. That's what makes it work. You live below your means in a city that constantly asks you not to. Your peers upgrade at every raise. You watch them. You say nothing. You understand the gap between income and wealth now. Income is a rate. Wealth is a stock. Increasing your income without controlling your conversion rate just produces a larger lifestyle. Nothing accumulates. You filed that observation years ago. You don't need to revisit it. The 2008 correction arrives. Your portfolio drops 32%. Your first property drops 18% in assessed value. You do not sell. You do not panic. You understand that correction is part of the machine's operation. You add another $200 to monthly contributions instead. Most people in your situation are terrified. You are curiously calm. You made a decision to hold years ago. You are simply executing it now while others break. Oh, you are 31. You buy a duplex, One unit for you, one unit to rent. The down payment is $34,000. You saved it across 4 years. No family loan, no gift. $34,000 from earned income held back from everything else across 4 years of chosen restraint. The rent from your tenant covers 70% of your mortgage. Your housing cost drops to $390 a month. You didn't buy glamour. You bought proximity to passive income. That is what it is. Nothing more. Your tenant pays on time, every month. You start to feel what the principle actually means in operational terms. An asset working while you are not. No deal flow, no board seat, no Bloomberg terminal humming at midnight. Just a rented unit on the second floor generating income while you sleep. The scale is different from the reference. The architecture is identical. You recognize that. You don't need to say it out loud. You are 35. Net worth is $198,000. No inheritance, no windfall, no asymmetric information. Just a savings rate maintained across 13 years and 2 market corrections survived without selling. You are not certain whether that steadiness is discipline or something closer to numbness. You don't investigate the question too closely. You move on. Your income reaches $78,000 at 36. Your lifestyle does not scale with it dollar for dollar. That gap is the mechanism. Every dollar between what you earn and what you spend is a unit being deployed. You don't use that language with anyone. Nobody around you wants to hear it. You keep it internal. You keep building. You realize that wealth building is less about exceptional returns and more about exceptional consistency. The market will deliver adequate returns if you wait long enough. Most people cannot wait. You've constructed your life so that waiting is cheaper than not waiting. That is your actual competitive advantage. Not intelligence, not luck. The ability to defer gratification at scale across 3 decades. At 38, you refinance the duplex. You pull $44,000 in equity. You use it as a down payment on a second rental property. You now own 2 income-producing assets. Neither was given. Both were built from surplus manufactured from earned income and chosen restraint. The structure is replicating. You feel something about this. Not excitement. Recognition. The machine is doing what machines do when you feed them correctly. You are 40. Net worth is $430,000. Not a number that makes you untouchable, but structurally different from where you started. You have assets generating income without your labor. You have accounts compounding without your intervention. You carry no high-interest debt. The geometry has shifted. You are not only a worker anymore. You are also a holder. That distinction is permanent. You don't explain it to anyone. Explaining it would require a shared language you don't have with most people in your life. You are 43. Your 401k crosses $310,000. Your brokerage holds $195,000. 2 properties with combined equity near $250,000. Total net worth approaching $760,000. You are not a managing director. You have not structured a leveraged buyout. You have not sat on a board or flown to Singapore for a closing dinner. But you built this from nothing using the same underlying principle the reference describes in billion-dollar terms. Capital held, capital compounded, capital not surrendered to lifestyle inflation. The scale is different. The logic is not. Your college roommate earns $68,000. He is a good man. You have not discussed money in years. Not because you look down, because the language doesn't translate. You notice this. You file it. It bothers you less than it should. The conversations you used to have about the future have been replaced by parallel lives with no common vocabulary. He talks about his bonus structure. You think about asset allocation. Neither of you is wrong. You've simply drifted into different frameworks for understanding time and resources. You wonder sometimes if he notices. You're fairly certain he doesn't. That specific phrase arrives fully formed one evening. You recognize where it comes from. You are not sure whether it applies. You move on anyway. You are 47. Net worth crosses $1.1 million. You didn't inherit a dollar. Your father never made six figures. Your mother retired on Social Security. You built this from a $400 savings account at 19, and a decision maintained across 3 decades, and a market that dropped 40% twice and recovered both times while you held. You feel nothing theatrical about the number. You feel something quieter, a permanent read of where the structure is relative to where it's going. Not happiness, not unhappiness. Those categories were replaced somewhere around year 20 by orientation, a constant positioning of the surplus against time. You keep building, not because you've identified an exit, because stopping has become impossible to envision.